Imagine money as a flowing river, always in motion, never stagnant. It doesn't linger in one place. It simply shifts from one bank to another. Most people approach this river with a small cup, frantically trying to scoop up enough to fill their pockets. Instead, they often find themselves drenched in bad debt, credit card balances, car loans, and student loans that bleed their wealth rather than build it. Billionaires, however, approach the same river with a different mindset. They don't chase the water. They construct pipelines powered by engines, channeling the flow to work for them. They don't fear debt, but master it, analyzing its costs and turning it into a tireless employee that generates wealth around the clock. When mishandled, debt can drown a family in financial ruin. When wielded wisely, it accelerates time, multiplies effort, and compresses decades of toil into a few strategic years of exponential growth. Below are 6 powerful strategies the ultra-wealthy use to harness borrowed money. Each method follows a simple rule. Debt must generate more cash than it consumes. Study the logic, keep the numbers straightforward, and see how every example reinforces this principle. First, borrow the product, not the cash. Consider a pen wholesaler aiming to ship a container from Shenzhen to Chicago. Paying $100,000 upfront would tie up his capital, limiting his ability to grow. Instead, he builds trust with the factory, shares proof of past orders, and secures the pens on 60-day terms. No cash leaves his account until he's already sold the inventory to local retailers for a profit. The factory benefits from a reliable client, while the wholesaler keeps his savings intact, using the same dollars to fund multiple transactions in a single quarter. This practice, known as trade credit, is the lifeblood of global commerce. It powers Amazon's supply chain, supermarket stockrooms, and car dealership lots. For billionaires who own or invest in these enterprises, the strategy scales seamlessly. By letting suppliers front the goods, their own capital remains free to drive marketing, innovation, or the next big acquisition, maximizing the velocity of their money. Second, transform a fixer-upper into a cash machine. Picture purchasing a rundown duplex for $500,000, putting down 20%, $100,000. You invest $50,000 in renovations, new paint, modern plumbing, and a sturdy roof. Tenants now clamor to rent, and appraisers value the property at $700,000. You refinance at 80% of the new value, securing a $560,000 loan. After paying off the original mortgage and renovation costs, you pocket approximately $110,000 tax-free, retain ownership, and let rental income cover the new mortgage payments. This buy, rehab, rent, refinance (BRRR) strategy is a favorite among professional investors, applied to apartment complexes, self-storage units, and mobile home parks. The key is to rapidly increase the property's value through targeted improvements. Cheap, long-term debt then unlocks your initial equity, fueling the next deal. By recycling capital this way, investors build portfolios that generate passive income and appreciate over time. Third, scale a thriving business with other people's money. Imagine an online cosmetics brand with consistent profits. A cautious owner might reinvest earnings slowly, waiting years to hire staff or boost marketing. A billionaire founder, however, issues a low-interest corporate bond to raise capital, hires a dozen sales reps, triples the ad budget, and negotiates bulk production to cut costs. Because revenue grows faster than the interest payments, profits soar. Global giants like Apple, Microsoft, and Nestle use this approach, borrowing even when flush with cash because the after-tax cost of debt, say 3%, is far lower than the returns on new ventures, often 10% or more. On a smaller scale, a dentist might finance a second practice, or a software startup could fund a user acquisition campaign. The formula remains constant. Borrow at a low rate, invest in high-return opportunities, pocket the difference, and outpace competitors who rely solely on organic growth. Fourth, use debt to amplify bets on market movements. Leverage in financial markets acts like a magnifying glass, intensifying both gains and risks. Buying stocks on margin allows an investor to control $100,000 in shares with just $40,000 of her own money. A 10% price increase doubles her investment, but a 10% drop could erase it. Advanced players, like hedge funds, Take this further with short selling, borrowing shares they don't own, selling them at $100, and repurchasing at $70 to pocket the $30 difference, minus borrowing fees. If the stock surges, losses can be catastrophic, so funds hedge their bets with long positions, options, and rigorous analysis. For aspiring investors, the takeaway isn't to dive into complex trades, but to understand leverage's power. Debt amplifies outcomes, so only borrow when the probabilities are heavily in your favor, backed by research and risk management. Fifth, live on borrowed money and minimize taxes at death. The buy, borrow, die strategy is a legal way to leverage wealth while sidestepping taxes. Step 1. Amass appreciating assets like luxury real estate, blue-chip stocks, or private businesses. Step 2. Use a portion of that portfolio as collateral for a low-interest credit line to cover living expenses. Since loans aren't taxable income, you avoid capital gains taxes. Step 3. Hold the assets until death. Under U.S. law, heirs inherit at the current market value, erasing decades of unrealized gains. They can sell the assets, repay the loan, and keep the surplus without owing taxes on the appreciation. This approach uses time, inflation, and the tax code to transform debt into a shield, preserving wealth for generations while reducing the government's share. Sixth, keep cash invested and let a low-cost mortgage carry your home. Mark Zuckerberg once took a 1% mortgage on his Palo Alto home despite having billions in cash. Why tie up millions in real estate when those funds could earn 5% in bonds or 10% in a business? At scale, every percentage point matters. An entrepreneur who finances a $2 million home at 3% frees up $2 million to invest in her company, where returns might reach 15% annually. Even middle-class households can apply this logic carefully. If a fixed-rate mortgage is below expected investment returns and payments are affordable, redirecting savings into diversified assets like index funds may outpace the benefits of paying off the loan early. The catch is discipline. Invest the surplus. Don't squander it on depreciating goods like luxury cars. Debt, then, is neither savior nor villain. It's a tool. Its impact depends on your knowledge, foresight, and restraint. Billionaires treat debt like a business partner, calculating cash flow, stress-testing risks, and exiting deals that underperform. They borrow in a depreciating currency to acquire assets that appreciate, turning inflation into an ally. You can adopt this mindset at any scale. Start with credit lines you can repay in a month. Scrutinize interest rates as closely as price tags. Treat every loan as a contract that must serve your goals. When debt puts more money in your pocket than it takes out, you're in control. When it drains your resources, you're enslaved. Choose mastery, and the same river that overwhelms the unprepared will propel your financial engine forward. Share your thoughts in the comments. Do you agree with these 6 strategies? If you found this valuable, like and subscribe for more insights. See you next time.